Tuesday, 4th August, 3:15 p.m. Nifty was trading around 24,460. 15 minutes later, Nifty's official closing price was 24,615, more than 150 points higher. But every single Nifty call option that wasn't expiring that day went down, while the official index number was jumping up in its final 15 minutes. One of these markets is lying, and by the end of this video, you'll know exactly which one and why. Because SEBI just changed how India's stock market closing prices work, and this week gave us a live experiment in what happens when a new system meets a market that doesn't trust it yet. So what is SEBI's new closing auction session really, and why is it replacing the old VWAP method? Every day at market close, the stock exchange needs to set an official number as the closing price for each stock. This number is what computes the Nifty and Sensex closing values and what their futures and options contracts settle at. It sets mutual fund NAVs and even what your shares get valued at if you pledge them. Until this week, the answer was volume weighted average price. Exchanges took the trades from the last 30 minutes of the day and computed a weighted average. From August 3rd, SEBI replaced this with a closing auction session. Continuous trading will stop at 3:15 p.m. and between 3:20 and 3:30 p.m. everyone's buy and sell orders gets pooled together in one single auction. Then the exchange finds the single price where the maximum number of shares can change hands, and that becomes the market closing price. So why change something that's been running for decades? 4 real reasons. One is real price discovery. Under VWAP, a big buyer at 305 and a big seller at 325 never actually meet. Their interest gets averaged, never directly matched. The closing auction session pulls everyone into the same 10 minutes so that the closing price reflects an actual point where the supply met demand, rather than a synthetic calculation. 2 is big orders get easier. A mutual fund trying to buy a large chunk of a stock has always had to slice the order into small pieces across the day, just to avoid moving the market against itself. Whereas in an auction pool, a large buyer is far more likely to find a large seller at the same price. That directly shrinks the tracking error for every index fund and ETF that is benchmarked to that closing price, because now they can actually trade at that number that their NAV is calculated from. The third is that it's harder to fake. With VWAP, a handful of trades at an extreme price in a moment with low liquidity could meaningfully skew the average. Under the closing auction session, moving the price means committing real capital across a real order book, and the exchange publishes the live equilibrium price and the buy-sell imbalance from 3:20 p.m. onwards. So any manipulation attempts would be visible as and when they're happening. Fourth is, this is what the rest of the world already does. The New York Stock Exchange, London Stock Exchange, most major global exchanges run closing auctions. This isn't India experimenting. On paper, this is genuinely a better system. But then, Monday happened. Nifty closed up 1.6%, and a big chunk of that came from one violent move within the new auction window. Sensex, on the other hand, closed up only 0.7%. 2 indices holding almost the same companies, but less than half the move. That divergence almost never happens. And the reason it was possible is that Nifty is calculated from NSE's closing prices, while Sensex is calculated from BSE's closing prices. Under the old VWAP system, that didn't really matter because both exchanges were drawing from the same continuous trading activity on the individual stocks' last 30 minutes. The closing auction session breaks that. NSE and BSE now each run their own separate auction, a separate order book, separate pool of buyers and sellers, even for the exact same stock. And those 2 auctions weren't even remotely the same size. Turnover was about 1,542 crore for NSE and just 9 crore on BSE. Tuesday, the market opened lower, erasing a chunk of Monday's move, and its close did something almost identical. Nifty ground lower most of the day, then jumped 150 points during the auction to close at 24,615. 2 days in a row, the same signature. A sharp up move concentrated exactly within that auction window. Now here's where it gets interesting. This is the Nifty call option expiring the same day, the 4th of August, 24,400 strike. It closed at 215. Nifty's official close was 24,615. Subtract the strike, 24,400, from that and you get 215, because an expiring options payout is a formula, settlement price minus strike, and it has to match. So it was up 96% on the day and almost all of it in the last 15 minutes. Now here's the same strike, 24,400, but expiring the following Tuesday, 11th. If the market genuinely believed that Nifty was worth 24,615, this option should be worth at least 215, plus some extra for the week of time still on the clock. It closed at 201.3. A call trading under the intrinsic value against the real price of the underlying is pretty much free money, which means the option market didn't think 24,615 was the real price at all. The 18th August contract and the monthly expiry contract both closed below what they were trading at prior to the 150 point up move. And then the August futures closed around 24,552, more than 60 points below the official cash close. Futures would normally trade at a premium to spot, especially considering that it's only the start of the month, so the real gap versus a normal market was closer to 80 or even 100 points. Every single non-expiring contract, both futures and options, converged on a number that was different from the official cash close. Why could this be happening? Normally, if futures trade unusually cheap compared to the spot, traders would buy the futures and sell the underlying stocks until the gap closes. But you can't sell the underlying stocks anymore because the auction is closed. Which raises the question, what happens the next open when both markets trade freely again? Futures gapped up 133 points while cash gapped up only 54. This means that although the actual impact of overnight Qs was 133 points, the cash market only rose 54 because the market decided that the previous closing price was not representative of the actual sentiment. The CAS is a better system on paper than the one that it's replacing, but so far it has failed to produce informative prices. The main issue is the lack of liquidity during these auctions. In the US market, the NYSE's close is much larger in both absolute as well as relative terms. The average cash traded throughout the day at NSE stands around $12 billion, whereas NYSE stands at around $80 billion. The CAS routinely accounts for around 10 to 12% of this volume at NYSE, whereas NSE's currently stands around 1.5%. Due to the high liquidity of their auctions, the closing auction session only has a 0.053% difference on the closing price of the S&P 500 stocks on average, compared to the VWAP of the final 2 minutes, compared to the 0.4 to 0.8% jumps we've been seeing on the Nifty index the past few days. The NYSE did take quite a long time to attract the volumes it does today, from the closing auction accounting for 3.1% of the daily volume in 2010 to 7.5% in 2018 to over 12% now. India, on the other hand, is on week 2. Do you think this problem will sort itself out as more people start using the auction? Or is this just what closing prices will look like from now on? Let me know in the comments below.